Is the real estate market crashing? Well, the major media outlets are definitely going to try to scare you into clicking their links so they could sell advertisements. But hey, let's get the full truth here. Check out what's going on in August, see what's going on in the macroeconomic overview of things, and get a real dose of what is possibly happening in the real estate market so you can make the most informed decision. Let's go. All right, so let's dive into some key indicators here. So first thing you want to know that the key policy rate has remained unchanged. The Bank of Canada did not raise it because there's clear cracks in the Canadian economy that they're pretty fearful of raising rates, but they said they'll leave the door open for more possible rates. Well, why would they do that? I'll get into that a little bit when I touch on the bond yields. The next reading will be October 25th. The bank's prime rate is still standing at 7.2% because the policy rate did not change. And the Canadian inflation number is currently at 3.3%, so 0.3% from the top of the target zone. And then the next reading that we're going to get is September 19th. That's when we're going to get the August numbers. In October, we're going to get the September numbers. And the Canadian 5-year bond yields, we'll take a look at those real quick. As I load them up here, I got them right here. They're at 3.914%. So why is the Bank of Canada leaving the door open for future rate hikes when so clearly we can see that there's a lot of cracks in the Canadian economy, and many people, economists, politicians, are pounding their fists on the table and saying, do not raise interest rates anymore. The economy can't handle it. The Canadian customer and citizen cannot handle any more rates. Well, the reason that the Bank of Canada is going to want to leave that door open is to use one of their tools that they have at their disposal, which is the words they use. Because if they say, "Hey guys, rates are over. We're no longer going to raise rates," the top of the bond yields essentially is like, "Hey, look, guys, the bonds, the top of the yields, this is where they're going to be at," and then people are likely going to start flooding into buying bonds because they're at the top of the yield curve. And then what's going to do is when demand increases in bonds, it drives the yield down, which then creates more liquidity in the market because as the yields go down, the mortgage rules and other lending products become a little bit more flexible and open. So for example, if bond yields keep dropping, the 5-year fixed mortgage rate is also going to drop, which is going to increase affordability and start allowing more monetary flow into the economy, which will then spur purchasing, which is going to lead to inflation. So they're going to use their tools, which is available to them, not only increasing interest rates, but also using words to scare people to think that they still might be willing to raise interest rates. Okay, so while we're on the topic of interest rates, let's quickly take a look at that. So our current best 5-year fixed rate is at 5.39%. The bond yield is at 3.95%, so the spread is around 1.44. So that's right in a neutral zone right now. So there could be a possibility if the bond yields fall a little bit further that the interest rate on the 5-year fix is going to come down. And if bond yields start shooting up for some reason, that spread is going to shrink. And usually around the 1.1, 1.2% spread range is when interest rates will go up to widen the spread. And usually around the 1.5 to 1.75 range is when mortgage rates will go down to shrink the spread. So right now we're sitting kind of in a neutral zone. So I don't expect the interest rates to drop anytime soon unless we see more of a dip in the bond yield. All right, so let's dive into the real estate market and we'll start with inventory. So our 5-year average for September for homes for sale is 236 and we're still undersupplied in the real estate market. We only have 227 homes available. If we take off the 7 conditional deals that are in the market, we only have a net inventory of 220. When we look at the inventory mix, we can see clearly that we're undersupplied heavily in the single family market. The semi is pretty close to our 5-year average. Towns are right on 5-year average, and condos are actually oversupplied in the 5-year average, which is pretty interesting. But typically in a market that's in a downturn, the condos are usually the first ones to come to the market because they're usually the ones that investors are holding, student housing are holding, and then there's usually more units available in terms of condos, so those will be flooding the market more often. If we take a look here at our 5-year average and our inventory chart, see we're just below the trend line here. We were on our way up to the 5-year average and then just fell short and started coming down. So that's where we're sitting on an inventory mix. All right, so let's get into the flow of the real estate market, what's coming into the market, what's coming out of the market, and how that affects the average sale price and all that fun stuff. So first thing we're going to look at is how many homes are coming to the market. So as you can see, in the month of August, we only had 6.5 homes come to the market every single day. So that's 15% less than the typical 5-year average in the Guelph real estate market. But that's not an uncommon story. As you can see here at the beginning of the year, we had upwards of 30% less homes come to the market than usual. And on a full annualized basis, we have about 18 to 19% less homes coming to the market. On the outflow side, which means how many homes are sold, we had a whopping 35% less sales in August than we typically do, only selling 3.8 homes a day. So when we look at the whole year, we could see that's not an uncommon story either, between 27-30% less homes being sold. On a full annualized basis, we have sold 22% less homes than our 5-year average. So you must think, okay, well, if inventory is coming to the market and there's no sales happening, then shouldn't inventory be through the roof? Well, that's just the thing, right? We have had less homes coming to market, so that's off-putting the amount of homes that are being sold. So inventory is still staying relatively tight, which we'll be taking a look at a little later on. And for failed sales, we have to remember that people sometimes put on their home on the market and they take them off. Just because they're for sale doesn't mean they still stay for sale forever. So the inventory also stays low because sellers are taking their homes off the market. As you can see here we had 2.9 sellers take their home off the market per day in the month of August, which is up 18% over our 5-year average. As you can see here, the whole year was pretty much green, where sellers were not taking their home off the market because they were being absorbed, where we had almost 50% less failed sales than we typically did. But now that's starting to creep up, and now we're actually failing to sell more homes than our 5-year average. Okay, so how does this affect everything? Well, let's take a look. As you can see here, in the month of August, our average sale price dropped to $771,000. So that sounds like a pretty big drop considering that in May we were at $882,000. But if you were watching these market reports last year and the beginning of this year, I was calling a dip back in November, and I was saying that 2023 was going to be a pretty stable year. What happened in Q2 is that we didn't have a lot of inventory, and I was saying if we get the slightest bit of good news, buying pressure is going to spark purchasing, and that's exactly what happened. We hit our trough in the market at $720,000 back in January of 2023. We had steady multiple interest rate holds. Bond yields were falling because there was a banking crisis happening in the U.S. So bond yields were being bought, which drove down demand, drove up demand of the bonds, but then drove down yields. And then that sparked a perfect storm for Q2 to have some buying pressure. And as you can see, prices shot up immediately once there was any kind of buying pressure introduced to the market. So what's happened since then? Well, we had 2 rate hikes back in May and June, and that sent the whole economy, the whole real estate market into a pause. We're like, okay, we gotta wait and see what's going on, which immediately cooled buying pressure, and that, as you can see, dropped prices from $882,000 all the way down to $771,000. So it's a significant drop. As you can see, it's almost $100,000 drop, but year over year, we're still up $50,000 from where we began. So is the real estate market crashing? Absolutely not. It's not even down compared to where we started this year. If we look at a year-over-year basis, last year we were sitting at $764,000, so we're actually up on a year-over-year basis. Well, what about 2 years ago? Well, as you can see here, we were at $759,000 back in 2021. So we're still up from our 2021 levels, and we're significantly up from our 2020 levels. So the real estate market is not crashing at all, and things are actually pretty stable considering the environment we're in, and then and with interest rates and all that fun stuff. So taking a look at that, our peak was still at $1 million. Last year was a crazy year. It was a big run up, big drop off. But if we look over the long term, which most real estate purchasers are long-term holders, you can see that we're actually quite stable over the last 3 years. Okay, dropping into some other indicators of what's going on in the real estate market. Yes, the market has slowed down a bit, but just like back in Q4 and Q1, any kind of good news for the real estate market or the real estate purchaser, it's going to spark purchasing pressure. And if we have no inventory on the market, it's going to start driving prices up again. And there's a lot of buyers that are fearful about entering the real estate market because they're worried that they're going to buy in the real estate market, it's going to crash. Well, again, since we have such an undersupply of inventory, and since we just came out of an unstable market where we were not sure if the Bank of Canada was going to raise rates or not, we could likely see that the Bank of Canada is going to be holding rates for quite some time here because there's a lot of cracks in the Canadian economy. Plus, interest rates have gone up, but pricing has come down. So with that being said, if you take a 1% increase in mortgages, if we go back to one. And I know I'm kind of freestyling right here. I apologize. Stay with me. I'm going somewhere with this. If we look at our interest rates right now, interest rate trend, back in Q2, we were sitting at 4.29%. We have currently gone up to 5.39%, which is a little over a 1% increase in mortgage rates. Well, if you apply a 1% increase in mortgage rates, and if you go back to the average sale price here, so 1% on 771,000 versus 1% on 882,000. So back here, you're getting the lower rate, but here you're getting the better price. So 1% difference, it actually ends up being the exact same amount for a monthly payment. So really, there isn't much difference. The price has come down to match the interest rate increase. So moving on from that, so if you're buying, my recommendation for you is to buy when others aren't, is to buy when there's a dip. I wouldn't be waiting on the sidelines and just watching, oh, okay, now there's people buying. Oh my gosh, prices are going up. Now I have to jump into the market because now I have fear of missing out. And my plan was to buy a house this year. Well, if you're planning to buy a house this year, I wouldn't be jumping in when everyone else is jumping in. You want to buy when people are fearful. So you want to buy when no one else is buying. And then you want to sell when everyone else is buying, right? So if you did buy an investment asset or you're buying something on speculation, you're buying a new build or something like that, where you're thinking about flipping it, you want to buy it when the market's down and then you want to sell it when everyone's going crazy for real estate. So that's just my 2 cents on when to buy. However, most people are in a switching situation where they're upgrading or downsizing to their home. So if you're switching in the same market, a lot of this won't really affect you that much. Especially, I would definitely want to talk to you if you're someone like this. If you have a locked-in mortgage and that mortgage is willing to port to a new house, you can do something what's called a blend and extend, where you can take your existing mortgage, port it over to a new house. If you have to increase your mortgage, you're only going to increase your payment, and the interest rate's only going to be affected on the new increased amount. So really, you have one of the best opportunities to buy the dip, in my opinion. Okay, so moving on, let's take a look at some other indicators. I know I went freestyle there for a little bit. I hope you enjoyed that. And we'll just take a look at some other indicators here. So days on market has crept up to 20 days, and still, it's not even close to where it was at the beginning of the year, which was at 28 days. Back in November, it was 30 days. That's when we were really feeling the low trough of the real estate market. And here we're back up to 20 days. So if we get another couple interest rate hikes, so my expectation in October, things are likely going to be picking up again. Okay, list price to sale price ratio in the real estate market. First time we dipped under 100% for a few months there, but again, average list price to sale price ratio is very strong still. It's all looking pretty stable in my opinion. Okay, let me show you one more thing. I'm going to pause just so I can regroup, and I'll pause and we'll go to the next thing here. All right, now that I'm back on track here, let's take a look at this one last thing that I got to show you here. This is the overall market overview, and I just want to quickly show you what's going on. So the green line here represents how many homes are coming to the market. The red line here is made up of 2 other lines here. The red line is made up of this orange line and blue line combined. The orange line here is how many homes have sold. The blue line here is how many homes have failed to sell. And these 2 lines together make the red line. As you can see here, we had a little bit of excess inventory coming to the market, and now we could see that we had a little more outflow than inflow. Is why and exactly why the inventory is staying low. And here's some other information here. The light gray line is how much is the current inventory, and the dark gray line is the 5-year average. It's crazy to see that we've had hardly any inventory on the market considering sales are considerably down. And now we're just finally getting to normal inventory levels. But the worrisome thing here is that more outflow is happening again, which is driving less inventory. So what does this all mean? What am I talking about? Let me just sum it up here. Year to date, we've had 1,900 homes come to the market. We've had 1,200 homes, almost 1,300 homes sell. And as you can see here, 18% down to 22% down. So that's pretty much washing each other out. Failed to sell homes, we've had 555 homes fail to sell. So that's still actually better than our 5-year average. And definitely last year, we had a ton of homes fail to sell last year. So we're doing much better than that. But year to date, we've only added 74 homes to the market. So that being said, inflow minus outflow, we have a total net gain of houses. We've only actually added 74 houses to the inventory this year. So that's going to help me identify months of inventory. So with 227 homes on the market, taking 6.5 homes coming to the market a day, that's going to be another 194 homes coming to the market in the next 30 days. So that's going to give the market 421 homes to buy. Okay. Well, how many homes are selling? Well, there's 3.8 homes selling a day. So that's 114 homes are going to be sold if the same trend continues. That means at the end of the next 30-day cycle here, there should be around 306 homes on the market. And then if nothing else changed and those 306 homes stayed on the market forever, how long would it take to buy all the homes? Well, it would currently take 2.68 months to buy all the homes. And what does that mean? Well, if this number was one month of inventory, that's a pretty hot market. It's a seller's market. Back at the peak of the real estate market, this was actually at half a month of inventory. It was red hot. Closer to 3 to 4, that is definitely in the buyer market zone where there's way too many homes on the market, not enough buyers, and prices are definitely falling because buyers are just having their choice and just waiting for more homes to come in the market. Currently at the 2.68, we're a pretty balanced market. And this is actually a really nice market to buy in. It's not too much pressure. You have some negotiating opportunities. You have some time to put conditions in. You don't have to go firm and crazy and all that fun stuff. So it's actually a decent market to be buying in. And there's not a lot of buyers in the market right now. As you can see, only 3.8 homes being sold a day. So if you're looking for a decent deal and you're looking to make sure that you have an opportunity to buy a dip, I think you have a pretty good opportunity right now. Anyways, if you want more customized, tailored advice to your specific situation, you always know where to reach out. Reach out to the Zon team. I'll throw the number up here, and I'll look forward to hearing from you. I hope you enjoyed this market update.